And so a lot of people have deemed it recession proof. I believe I came up with the term recession resistant. As soon as you say it's a proof in anything in real estate, you're going to get hit on the side of the head and knocked around.
Welcome to the Freedom Point Real Estate Podcast, where we talk about creating more time freedom through passive real estate investing. Passive investing in real estate challenges conventional investment wisdom. We are passionate about learning and sharing resources with others who are ready to transform their investing mindset. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice, not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer, ADP. I'm glad you're here. Now let's dig in. All right, welcome back, Freedom Point Podcast listeners. Thank you again for jumping into another episode of the Freedom Point. My name is Jeremy Dyer, and I am your host today. And I've got a great guest with me today, Scott Krone. Scott Krone is the founder of Coda Management Group. He began his real estate career with a master's in architecture. He's been involved with architecture, development, contracting, and management for 30 plus years. Really excited to have Scott on the show today to talk specifically about an asset class that we have yet to talk about today on the show, and that is the self-storage space. So Coda Management Group is also actively involved in, of course, acquiring assets to reposition them as self-storage facilities or locations under the brand name of One Stop Self-Storage. So Scott, without further ado, welcome to the show.
Thanks for having me, Jeremy. Thanks for reaching out. We really appreciate this opportunity.
Yeah, absolutely. So can you tell us a little bit more about your background and journey into self-storage real estate investing and what drew you to this niche in particular?
Well, I can honestly say I didn't grow up dreaming of being a self-storage owner. You know, that was not the dream as a 6-year-old. So I got into architecture, getting my master's in architecture because we sold our family business, when I was in college. And so originally I thought I would be going, growing up, I thought I'd be going into the family business. And my parents arrived my senior year and said, "Oh, by the way, we're selling the business." So that really altered my framework and my perspective. And so as I began pursuing my architectural degree, I had a professor who was a real estate developer, an architect, contractor, and did a little bit of property management. And so a lot of the work that we did in studio was actual work that he was going to be building. And so my master's thesis was a 400 unit, $100 million project that, I worked on in class for him. I worked out of class for him. And then in homework, I worked for him. So that was my 3 years of graduate school. And I continued to work for him. And then shortly thereafter, I started my own firm. And we were doing design build and began in single family and then quickly moved to multifamily and mixed use. And then the crash occurred. And it was during the crash when everyone was being forced into multifamily because that's where lending was. That's where you could get loans. I was coaching real estate and I had some clients that were beginning to investigate self-storage. And for me, it was a simple transition because, if we're looking at real estate, everything from, I've worked on $14 million homes all the way down to a $100,000 townhome. What we're really dealing with is a box, right? And it's just a matter of how elaborate that box is and what we use that box for and, how big that box is. And so the planning of self-storage, the management of it, the construction of it was all, for me, a much more simplified version of multifamily. And so, but when I began studying the economics of this, I realized how resistant it was to recessions. And so a lot of people have deemed it recession proof. I believe I came up with the term recession resistant. As soon as you say it's a proof in anything in real estate, you're going to get hit on the side of the head and knocked around. So, I never believe that there's a one thing. And so, that's how I got into this. And, we began developing them and then we began owning them and then we began managing them based out of what we saw as inefficiencies in the marketplace.
Thank you for that summary. So you mentioned a recession proof, and I know what you mean when you kind of speak to the fact that, what's really recession proof, what's not, nobody's got this crystal ball. I get that part of it. But in principle, why is the asset class of self-storage, somewhat recession proof as opposed to some of those other assets? Is it because during times of recession, people need a place to store their stuff if they're downsizing? Is it because during times of economic growth, people just buy more stuff and they need a place to put their stuff, right? Like, I'm just trying to understand, why is it that self-storage, as opposed to other asset classes like multifamily or assisted living or, retail, et cetera, why is self-storage more recession resistant than some of those other asset classes?
Great question. I think, if we let's just compare two asset classes to make it simple. So if we look at like multifamily, the ebbs and flows of multifamily are based upon pretty much interest rates, right? So as interest rates drop, and if there's a normal supply of housing, which we've been in a glut. So right now, since the recession, we're in this massive glut of housing because the housing starts has not kept up to where it was pre-pandemic. That as interest rates fall, it's better to be an owner than a renter. If the cost of living drops, then you're better off. That's why we saw in the 80s and 90s a lot of apartments being converted into condominiums. So at that point in time, it became very costly to own apartments because interest rates were just so low that it was better for people to buy. After the great crash, you could buy a house in Phoenix, Arizona cheaper than you could rent an apartment. So people were buying these homes. So that's why multifamily was fluctuating in those markets. But to answer your question with regard to self-storage fundamentally is addressing someone's pain. I tell our salespeople we are in the pain management business. And it's not necessarily a negative pain. It could be a positive pain. Like 50% of our clients are businesses and 50% are individuals. They could be growing their business and they need to supply, place to store inventory. During the recession, it was, hey, I had to buy a whole bunch of inventory and we need to store it because we don't know when we'll get the next shipment. It could be that our lifestyle has changed, but I can't find another house. I can't find another home for me to move into because the market is so where it is right now. So I'm using my house differently. I'm using it as a gym. I'm using it as a school. I'm using it as an office. And so that has changed. And so we're in the ones that you brought up in a recession is I lost my job. Now I need to downsize, but I don't want to get rid of my stuff. Or I had a death in the family and I need to get my parents' stuff out of their home and I don't know what to do with it. Or I'm being relocated and I don't want to sell my stuff or I can't move it right away. So all of these things are addressing a pain point in someone's life, and we're there to help them solve that problem.
Yeah, no, that's a great point. I was kind of thinking to myself, there's a reason why I am personally have a self-storage facility where I store my stuff. And that's because I have 4 children. And with 4 children come 4 bikes, come 4, all kinds of different stuff that consumes my garage space, right? So I have to have a self-storage facility outside of my normal home because I don't have enough garage space to store all the kids' stuff, if you know what I mean.
Absolutely. The biggest hindrance to self-storage are basements, attics, and garages.
Yep, absolutely. And you had mentioned something else which is interesting, and that is, the cost to own a home today relative to the cost to rent. Okay, there's a very big gap that exists in that today. Okay, more so than really in recent past. And so I could see a lot of people, that traditionally maybe formerly could have afforded, a single family home, now instead maybe making that transition into living in an apartment. And typically when you do that and you downsize, or rather than buying the single family home, you instead right out of the gates, maybe you start to rent, you've oftentimes have to have a place, to put things and belongings because you just don't simply have enough space, to keep those things, within your, confines of your apartment space. So that's a great point.
Absolutely. Now the interest has inverted, right? So now people can't afford to buy the house. So they're being forced to stay where they are because they can't alter because of the interest rate. As you said, the buying power is decreased.
So let's talk about Coda Management Group here for a minute. So if I'm understanding it correctly, you're primarily focused on the reposition of a non-traditional asset into a self-storage facility. You're not involved in ground up development, building new boxes on dirt. Am I correct?
We do both. A lot of our existing portfolio is we're converting existing buildings into self-storage because we see that there's a need within that 3 to 5 mile radius. and it's cheaper for us to buy an existing building and convert it rather than building a new. But we are also working on new construction as well.
Okay, let's talk. Maybe give my listening audience an example of maybe one or two projects that you've worked on in the past where you acquired a non-traditional type of a building and you converted it into self-storage. I mean, are we talking about like, former McDonald's restaurant locations here, or are we talking about, traditional office spaces, hotels? Like what are some of the, non-traditional assets that you're acquiring and then repositioning them into self-storage facilities?
Our Chicago location was actually the original factory for the Lincoln Logs. And so, that was historic in nature. Then for us, we appreciated it. Not too many people know this, but Frank Lloyd Wright's son created Lincoln Logs. And so, him being a big influence here in Chicago, it's nice to have that tie back to Frank Lloyd Wright. Our property in Wisconsin was the first fireproof building in Milwaukee. So it's 8 stories. And it was a car showroom. It was a Harley Davidson showroom. They used it it had bank vaults in it. And so like we kept the old original big metal doors with the cylinder locks and all that on it. And we got historic tax credits for that building. And then we had 2 others that were, underused. Like one building in Dayton was a 6-story building that was vacant for like 30 years. And there's a lot of growth and explosion of growth and development right around it. And we saw it as a good market because there was 1,000 apartments being built right within 3 miles of it. And so we came in, and it couldn't be converted into multifamily because they didn't have any parking. And so with self-storage, we don't need a lot of parking. We only need like 4 or 5 spaces.
That makes sense. Now we both know, and everybody know that, every investment involves a certain degree of risk. So what are some common risks associated with self-storage real estate, and how do you as a company approach risk management into your overall portfolio?
That's a great question, because, self-storage is also a retail business. And so it can be tracked and it can be monetized. And so, we have software, we have technology where we can see what the competition is within 3 and 5, 10-mile radiuses. And so one way to look at that or to, analyze it is the square foot of lockers per capita. And historically, the national average was 7 square feet per capita was like the saturation point where, supply equal demand. And if you were below that, it was a great condition. If over that, that's where you would struggle. And so we always look for that. We always look at the demographics to determine, what size of storage we should be putting in. The more affluent, typically they want larger units. If they're remodeling a house, like we had a facility up in the northern suburbs of Chicago, and we would see like 8, 10 by 10 and 10 by 20s being loaded up in a single day. And it was someone was, remodeling their house and moving all their furniture, all their belongings into these lockers for, 9 months to 9 to 12 months while they did the remodeling. And then, one day all of it would be moved out. But, they wanted that. They prefer having larger units. In less affluent areas, they're willing to pay a higher price per square foot for smaller ones. So we're always looking at what our competition is within that 3 to 5 mile radius. We're looking at what our replacement costs are, how we can build it more economically, more efficient. And then the other thing we did is we opened up our own management company. So if you were to come to us and say, we wanted to manage your facility, we don't do that. We only manage our own because we saw that there was, using third-party management, we had some managerial issues that were not the best financial situation for us.
Sure. So you're vertically integrated on the property management side. Let's talk about technology, because you brought that up before. I'm sure that technology, since you've been in this business, which has been 25, plus years now, technology has been introduced into this industry in a large degree. I'm sure it takes less manpower on a local boots on the ground, perspective than maybe it did, 25 years ago. So let's talk about maybe how technology has really kind of transformed the self-storage industry.
I'm going to say real estate in general. I mean, when I began, I was hand drafting everything. We were, it was all Mylar paper and pens and straight edges and T-squares and angles and all those sorts of things. So, obviously everything is now CAD. which is a huge transition. I mean, and the CAD has now become vertically integrated into 3D modeling. And so we scan buildings now. Instead of going and measuring, we can literally 3D scan a building. So if you think about just traditionally the speed of progress, for 2,000 years, architects were, basically drawing the same way. And then all of a sudden we're integrating massive technology that not only makes it, two-dimensional, but three-dimensional and also complete modeling. It's pretty incredible to see the growth curve there. But on the self-storage side, what we're seeing is that more, everything is online. I mean, we have some facilities that are remote, that we don't have anybody on site, so we have someone that goes in and makes sure it's cleaned up. If we have to overlock, those sorts of things, that we call them the director of beautification. But the sales is all done virtually. So signing contracts, payments, all that. We've stopped taking cash. One of the facilities we bought, the guy had a mail slot in the side of one of the lockers. It was a drive-up facility, and then he had to shoot into a vault, into a safe, not a vault, but a safe. And he would come out with like wads of cash, and he ran his books in a notepad and a cell phone that he would text people. It wasn't even a smartphone; it was a dumb phone. And that's how he was running this operation. And so, we've fully automated the system. We have key codes to get in. We have cameras. We have, payments, all the contracts, everything is done 100% online. And so, when we're looking at even the banking and the accounting of it, we have a much more accurate accounting of things because of the fact that everything is, digitally, electronically payments and stuff like that.
Yeah. Now, Scott, you've been at this game for a long time, a lot longer than a lot of people that I know that have gotten into, real estate in general, say within the last 5 or 10 years. So you've seen a lot of economic changes. You've gone through a number of different economic cycles. So what have some of those economic cycles taught you as an investor?
I've been through 4 so far. And I think we're in the middle of one. And this one's a weird one because we have a lot of false things propping this up. We have, the Fed raising rates incredibly, which normally would, slow the economy down. But we have so much stimulus being pumped in the economy to keep it going, which is putting this huge pressure on us in terms of our debt. So it's a strange economy that we're facing right now. But the cost of living has skyrocketed, but wages aren't really increasing that much. So there's a lot of, we passed the inverted yield curve, which typically signals a recession that happened over a year ago. So it's a weird situation that we're currently in. But the biggest thing I've taken away from all of these, going back to like when I first started in the 90s, when oil was huge and inflation, the interest rates were higher than they were now, was the need to be flexible, to be able to pivot and to pivot quickly and well within the business, but not to think that you control the market. That goes back to, is it resistant or proof? Anytime that you think you can control the market, the market, the market is a powerful beast. And, you have to be able to go with the market rather than fight the market. And, early on in our career, when the crash occurred, I had a partner at that point in time who wanted to keep doing the same things, doing spec homes. And, we were very successful at that. And I said, we can't do that. And he goes, well, why not? I go, we can't get loans. Banks will only give us a loan for like 30 or 40%. And it's going to be like, 10% interest rate. It's like, why even borrow money at that point in time? We can't build it with all cash because the rate of returns are going to be so low. And, banks are just not lending on this. And so, I went into more of the storage area at that time, and he continued on the multifamily, the single family, but he's out of it. He's out of real estate right now in terms of development. So, you need to have a component of flexibility and understanding what's going on in the market and being a student of the market to see when things are coming. I can't predict everything, but I have a general sense of the bigger waves. Does that make sense?
Yeah, it totally makes sense. And I appreciate you highlighting that. To me, it sounds like, one of the pillars to your success in business over the last 25, 30 years has really been your ability to kind of reinvent yourself, from a mindset perspective, reinvent the company, transformed the company. And it's kind of that, general sense of always needing to be nimble. I believe you used the word pivot. Am I correct?
Yeah, I believe so. And I spent a lot of time and energy working on transformation. I believe transformation is important on a personal level, but then how it also applies in terms of leadership and then ultimately the direction of the company. So, for me, I focus specifically on myself in terms of how can I transform my own life, how I go about doing things, and then how that impacts my leadership ability. And then also how does it impact our business?
Yeah. Now, I know that there's no guarantees, Scott, in terms of, what investments can produce to a limited partner investor, but what are typically some of the return projections that you would make to a limited partner investor who is interested in partnering alongside you on one of your future investment opportunities?
Well, if we compare like self-storage to multifamily, and I was just having this conversation yesterday with my partner. When we look at, if multifamily was trading at a 4 cap, self-storage would be at a 5 cap. So it would always lag by 1 or 2 points behind, depending on the market, depending on the asset class, all those sorts of things. So when we look at that, that would be an indicator of the strength of it. And right now, surprisingly, I was on a call with Marcus and Milchap, and they were doing a state of the economy yesterday. And they were saying that self-storage currently is now between 5.5 and 6.5 cap, despite the fact that the interest rates are higher than that, which is an interesting component because usually you had the delta the other way around. Mm-hmm. So I was surprised to see that. Now, if we compare an existing facility versus a new construction, typically I've seen deals structured. They would have a pref, an 8 or 9% pref. And then, try to get into mid-teen yields on an existing facility and trying to improve it, develop it, expand it, automate it, those sorts of things, taking it from a mom and pop into, a more efficiently managed facility. That would be the typical rate of returns that I've seen in the marketplace. When I began in development, my professor / boss always said, we have to model things over 20% if it's new construction because of the level of risk. You have this increased risk associated with it. And so that has been our northern light in terms of how we approach it. We always make sure that we have a 20% spread in terms of the end value versus the cost, but then how we leverage it. And so, we look at how we can be, how we can be creative in the capital stack. We've used PACE financing. We've used opportunity zones. We've used historic tax credits. These are all tools that we've used in order to increase that leverage in order to maximize the rate of return. But we always model things over 20% when it's new construction based upon the level of risk and also the time frame.
And speaking of the time frame, what is the typical hold time period that an investor would be invested into a deal? I presume that they're illiquid investments, just like they are typically in the multifamily space. And then my second part of that question is from a depreciation perspective. I know that's one of the big draws, into the multifamily space is to be able to take advantage of the paper, passive loss activity, that's reported on an annual K1. Is that similar in the self-storage space? Absolutely. But I mean,
you asked 2 questions, right? So on the first part of that is, I think, well, let me address the depreciation. When we go into depreciation, if we're buying an existing asset, we'll do a cost segregation on the front end. And then once we approve it, we'll do a cost segregation on the backside. So we're actually getting double depreciation, if you will. If we compare that to an existing multifamily, you would probably have larger expenses because there's obviously more assets in it. So when we look at a self-storage facility, if we're building 600, 700, 800 units, our total cost might be under $10 million. But that's a $100 million project, $150 million project in multifamily. So the relationships are a little bit different there. Self-storage is a lot easier to get into, but we also have a lot more flexibility because we can change the unit configurations a lot easier. It's another way in which we control risk. So when we're looking at those returns, the depreciation really happens in terms of cost segregation when we do the improvements. If we buy an existing facility, it's going to be more of a straight line yield curve in terms of the depreciation versus the development. So yes, we always get those sorts of things. With regard to the second part, the first part of your question, which I'm answering second, we typically look on a development is like 3 to 5 years, because we have to go through the whole lease up process. So we have to do the construction and then the lease up, which depending on the market is anywhere from 1 to 3 years.
That's great. Thank you for highlighting that. My next question is what's up next for Coda Management Group? What's next on maybe your bucket list item, or kind of your next focus?
We're in the process of changing that of our model again. So we see now as an inflection point and a pivot point, and we're on the cusp of really launching a whole new product line. And so it will be in conjunction with multifamily, in conjunction with self-storage in tandem. And so we're bringing the two asset classes together.
That's great. What are some of the challenges that you're kind of envisioning, achieving that objective?
Well, anytime that you create something, right, you have to get buy-in. You have to get it into the marketplace and do that, right? And I think, being an entrepreneur, you're constantly having to sell, right? And what we're selling is right now this concept of how it will work and how it will work in the marketplace. And because it's never been done before, now we can say I've seen self-storage, I've seen multifamily, but there's multitudes of layers in terms of what we're doing here that's going to differentiate our product. We need buy-ins from communities, we need buy-ins from corporations, we need buy-in obviously from banks, from equity investors, all of these things. And so, a lot of it is, putting together how we're going to be presenting this and making sure that we have the systems to make sure that they work.
Absolutely. What would be maybe one or two book or podcast recommendations that you would be willing to, share with my listening audience that you've found some value in?
Well, I think the biggest thing that, for me, we go back to transformation, and understanding oneself better in order to understand how you interact with others, and then for the sake of others, that's been a huge transformation in terms of how I view what I'm doing in my life. Is it for me or for the sake of others? And for me, that book was The Road Back to You by Ian Morgan Krone. No, and I don't know if I'm saying it right, because I've heard people say it two different ways, but that's my interpretation of his name based upon my last name. But no relation, different spelling, and I'm not getting any residual kickbacks. I just want to be clear on that. But it's about the Enneagram and understanding the personality types. And this is something that like 4th century monks created and developed. And these guys were geniuses. I don't know how they came up with it, but it is a truly incredible tool to not only understand yourself, but how to understand others and how to better interact, with that. And there's great insights first into yourself, and then to see how you interact with others.
Yeah, absolutely. I'm a big fan of, leveling up your game, so to speak, and, daily finding ways to become a better, version of yourself. So I appreciate that book recommendation. I have not read it before, but we'll definitely add that to the show notes for the listening audience here. Scott, what would be maybe one or two different ways that our listening audience can connect with you and learn more about what you're up to?
We have a couple. Our website, the best one to take a look at is www.codamg.com. And if you want to see our end products, that would be onestopselfstorage.com. We have them throughout the Midwest. And those are the two ways. And then info@codamg.com. And if someone does reach out and wants to learn about self-storage or about, the investing process within self-storage, if they reference this show, we will be happy to give them a couple gifts. One is a feasibility study from one of our past projects, so they can see what we're talking about in terms of these demographics and the understanding the market and how it plays into it. And the other one is a self-storage deal analyzer. And so we'd be happy to give those resources out to your listeners.
That's great. Thank you. And thank you for the free gift, by the way, for our listening audience. And we'll make sure to add some of those resources in the show notes for this episode. Scott, again, appreciate you joining the show, and thank you for being with me today.
Thanks for having me. I appreciate it.
Absolutely. And listening audience, thank you again for joining another episode of The Freedom Point. Look forward to having you join us on the next episode.
Thank you for hanging out with us today and for listening to the Freedom Point podcast, powered by Starting Point Capital. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decision, please consult with a professional. This show is copyrighted by the Freedom Point podcast. Written permissions must be granted before syndication or rebroadcasting. If you're interested in connecting, you can find contact information at startingpointcapital.com.